because everybody says I underwrite very conservatively, but that's a misnomer. One person's conservative is another person's liberal. And so you need to understand the basics of underwriting. I mean, you can get blown away, even I get blown away in some pretty heavy multiple decks of Excel spreadsheets.
Welcome, my fellow Flow Masters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority. This show is for high-performing professionals who did everything right: the degree, career, and the income, but you still feel like there's another level waiting. And so here we explore how real estate can be that next challenge worth building so that you can take ownership of your future and really create a life by design. So today, joined by another amazing guest. This is Mr. Randy Langenderfer, and Randy is president of Invest Ark Properties, where he focuses on recession-resistant multifamily investments. So big multifamily investor over here, and provides passive wealth and tax advantages for busy professionals. He's also a CPA and MBA who serves as independent director and Audit Committee chairman for Summa Health System. So welcome, Randy, to the show, and happy to have you on today.
Hey, Chris, thanks for the invite. It's my pleasure. I'm really glad to be here.
Yeah, you bet. So looks like you build a pretty sizable portfolio for yourself. Is it 4,000 units? Did I have that right?
Between active and passive, yes.
Okay.
I don't know. Yes, it's close enough.
It's a big enough number where, you can lose count.
Yeah.
We'll say that. Yeah. So I guess the question is, how do you systemize something of that size, 4,000 units, while still serving as a C-suite executive?
So I loved your intro to your audience. Those who have done it right, what'd you say? College, income, and what was the third one?
Oh, it's high-performing professionals. So, people, most of my listeners, they have a day job, and they're either looking for another option or just want to maximize building wealth for their future.
I was that guy 12 years ago. I was working for a private equity company, Carlisle, for any of those that are in the PE world, big Carlisle company called Vance, which was a spinoff of Goodyear Tire and Rubber in Akron. And I had come to that conclusion that, I'm doing really well here, but there's no safety, there's no security in corporate America. I need to find another income. So I had a brother-in-law that got me into flipping houses, and I thought he was crazy. But we were the hard money lenders. We were the bank. We were the ones lending money to the people. And so we weren't pounding nails. That was successful. I had one downfall, but we can talk about that if you want. But I needed to find another job as the private equity was winding down. I landed for a large academic medical institution here in Houston, Texas. And I did that for 10 years before retiring in mid-23 to do this full time. So how I did it was I started out, as I said, as a hard money lender for, 3 or 4 years, 2 or 3 years, doing single family fix and flips. And, that's a nice little sidebar income, but it really is difficult to scale wherever you're at, because each new property requires looking at budgets and looking at comps and repair values and cost estimates. And it was just very time consuming. Moved to Texas, found multifamily at a seminar, one of the large educational institutions here in Houston, and really loved the fact that I could buy, when you buy a single family home, it's a recourse loan. So if it fails, creditor's going to come after you. Really loved the fact that season of my life that I could buy a multi-million-dollar multifamily unit with non-recourse debt, meaning that if the property failed, they wouldn't come after my house, my cars, my retirement benefits, et cetera, et cetera. They'd take the property back and I'd lose that. That just really intrigued me. And so perhaps a long-winded answer, but I started investing as an LP in other people's deals, continued my education, did my first GP in 2018. Today I'm a GP in about 1,200 doors, 5 different properties, and I continue to be a limited partner in other people's deals. I really like the real estate asset class. So
yes,
I'm convicted.
Yeah. Well, obviously I do too. Hence the podcast. But okay, and then what's kind of your role? So you got into the general partnership side. What's kind of your role as a general partner? Does it change from deal to deal, or do you kind of have your thing that you do?
The short answer, it changes from deal to deal. So there's different pieces of the general partnership. I have been the person who identified the deal. Another deal, I've been the person that is raising capital. Another one, the asset manager or some combination thereof, or being a key principal, signing on the loan. Probably two of each of those. But generally speaking, I'm a joint venture kind of partner. So I have operated before, but I'm weaning out of that. I like to partner with people that want to do more of the operations than I do.
Yeah.
Just because of time and my season of life.
Off. Yeah. Do you get heavy on, I'm assuming with your background, you probably get pretty heavy on the underwriting side of the deal and making sure you feel warm and fuzzy about the actual numbers and the business plan?
Yeah, that's what I kind of did in the corporate world. I always say I used to do risk mitigation on the corporate side of trying to minimize different risk across the corporate enterprise. And so, yeah, the analytical mindset is alive and well with me. Sometimes that's a detriment. Sometimes it's advantage. I probably say no to a lot more deals than I say yes to, just because of that. And as I age in the market we're in, I get even more particular about what kind of deal I'm going to get into in the future.
So not every deal is a deal? Is that what I'm hearing?
Nope. Some of the best deals I've done are the ones I never did.
Yeah, there you go. And when you are underwriting for the big multifamily deal, like what are some of the biggest things you look for on the positive side, as well as kind of the deal killers for you? And I know that some of this might be personal.
No, that's
for
fine.
You, but yeah.
Some of it might be personal to you, but for your audience, though, I would encourage the high performer or listener of this that's in that high W-2 job that's got to take the time to educate yourself on the pros and cons of underwriting, because everybody says I underwrite very conservatively, but that's a misnomer. One person's conservative is another person's liberal. And so you need to understand the basics of underwriting. I mean, you can get blown away, even I get blown away in some pretty heavy multiple decks of Excel spreadsheets. But key takeaways to look at, what are the major, so if you're a limited partner and somebody's presenting you with a deal, I coach people to take a look at the macro level things, beginning with what are the rent increases assumed? What are the expense increases assumed? So in today's market, if somebody shows you a deal and they're projecting 3 or 5% rent growth in year one, I'd say in today's market, that's very aggressive. I think in year one, you start with 0 and hope you get something in year 2. And that's pretty much, there are going to be exceptions to that, but rent growth, expense growth. I live in Texas. You said you do too. So Texas and the South are huge with insurance and taxes. So what are the general partners' assumptions when they're creating a pro forma for taxes? Are they underwriting 100%, 90%, 60% of the future tax increase? So that'll give you an indication. And the one I love the most that is hidden very well is the reversion cap rate. So that is an assumption that every underwriter makes, that 5 years down the road, we're going to sell this. And the cap rate today is 5%, and we're going to assume it's at 3% in 5 years. And you're astute, you know that as cap rates decline, prices go up. As cap rates rise, prices go down. I think that we all hope for lower cap rates. But as I've said to a couple of my partners, hope isn't the best strategy. So I would encourage people to think about a static quo, if not a small rise in cap rates 5 years out, to be conservative.
This is the part. So for my background, I'm still kind of, I love 2 to 4 unit deals. Because for me, where I mostly invest in Wisconsin, the cash flow is just juicy as hell, and I can usually find a way to hustle into it. And I mean, frankly, do it myself or JV with one person, or, borrow some money and then pay them back quickly kind of thing. So, but nonetheless, when I'm doing that, yes, I still project a little bit into the future, but it's like there's no other investors who are relying on a certain return. I need this return. And so there's less pressure. So I'm not really as concerned about it. So now when I'm like, because I have been submitting offers on bigger, double digit, multifamily deals, 28 units, roughly that size. And so now I'm projecting out and all the things you're talking about. And so this is, to me, like when I look at the stock market and all these guys are trying to project and time the market, and I'm like, man, isn't it kind of the same? I know there's indicators you can look at it, but like how much do you really try to project versus just, this is historical, we'll adjust a little bit, but there's uncertainty. I mean, it's just, who knows what the future is going to bring.
Count your blessing. And to your audience, there's nothing wrong with those 2 and 4 or 5, 10, 15, 20, 30, whatever units you want to buy. Because you're right, if you can do it with your own resources, kudos to you. And you said the cash flow. But when you start asking other people for their money, the game changes and the risks go up. So to scale, it kind of requires that, unless you're going to just be slow and steady and do it over 30 years or something. There's nothing wrong with that. If you're there's nothing wrong with that at all. There's nothing wrong that people have, 10 or 5 or 2 rent houses. That's great cash flow too. So at the end of the day, it's what do you want to do? But when you start to underwrite for more doors, you're right. But you have to make some assumptions someplace. And, even on your 2 unit or 4 unit, well, what if the market rents go down 20%, 10%? You have to kind of plan for that somehow, or you hope they go up, or at least have a strategy what you're going to do if that happens. And regrettably, I can make, and you can make, any spreadsheet look good. You can make any spreadsheet look good, but the reality is what's your track record in implementing that, and what are the assumptions you're making? How realistic are they?
So like, okay, guys like us, we can look at somebody else's spreadsheet, and they can lie to us and say, these are the numbers. Look at the numbers. The numbers are good. The math is the math. Okay, yeah, but that's because of these assumptions you made over here, right? So I guess, what about for people who want to get into this passively and they're not, they're not analytical minded like us, and they don't look at spreadsheets every day. I don't know if you have any tips.
Well, they don't want to
like that.
Yeah, they're the people that, and we need those. But I always say there's a difference between investing and speculation. So speculation is what I do when I throw money at a 401k and I put it in a growth fund or a foreign small cap or something like that. To me, that's speculation. I don't know anything about those other than it's got a Morningstar rating of whatever. But to me, an investor is somebody who understands the opportunity, the risk, and consciously accepts or rejects the thesis. So I go back to, even if you're a passive investor, you can make a strong argument there's no such thing as a passive investment. Even when you're a limited partner, you still have risk, and so you still have some due diligence. And so, I've talked to Chris. I have people in my network that I just send them a deal and they'll send me a check. It's crazy.
Yeah.
And then other people that want to discuss it for an hour, and that's okay too. And there's a red flag for your investment pool. If you have questions, my gosh, you could probably generate 20 just from AI today. And you don't have a general partner that's willing to take the time and explain it to you, move on. Even if you're perceived as a nuisance because you're in your first couple of deals and you want to ask a lot of questions. I remember early on I had a GP do that to me. He, after about 15, 20 minutes, he cut me off and I said, well, thank you very much, but no, move on, find somebody else. That's a red flag for me anyhow. But to your limited partners out there, to your high performance corporate guys, develop your investment thesis. What is it? Are you looking for cash flow? Are you looking for appreciation? Are you looking for both? Are you just looking to diversify? And I trust Chris, so therefore I'm going to give him $50,000. there's the whole spectrum there. But I think people ought to know the bare bones minimums when they're investing, but more so than the analytics, as you know, it really is true. Get to know the general partners, the Chris, the Randys in the deal. I mean, I'm sure I get a lot of opportunities to invest that come across my desk, but my investment thesis starts with, I'm going to invest in the Sun Belt region with a greater 100 doors or greater in the class B plus to C plus areas. So if somebody sends me a deck with a 20% IRR in Topeka, Kansas, no disrespect to Topeka, I don't even look at it. It doesn't fit my investment thesis. And otherwise, investors start chasing the shiny rabbit, right? It's the person with the sexiest deal or the greatest IRR. But, if you had a drug dealer come to you and say, I can get you 100% money in a week, it's true, but I hope you're not going to invest in it. Because it doesn't fit.
And I don't know. I know people who their thesis is, they want to buy in geographically diverse areas, right? Because they want that diversity. Okay, I get that. But even then, it's like, start one place, like pick one place that's high appreciation and one place that's high cash flow, like limit your places, because I've tried that. Like, hey, I'm just going to invest wherever the deal is. And that's going to bring me more deals. And I did nothing like when I did that. It's like, you try to market to everyone and you reach no one. It's the same principle, right? So,
ask those things of a general partner. So if you got a general partner that's specialized in Dallas, and they got an opportunity to sell investors on, and Atlanta's a great area, but you got to question, and that increases risk because you got to question that's their first time in Atlanta, and that's problematic. So not bad, but just be aware.
Yeah. So do you build a team at where you're investing, and do you use kind of the same people on most of these deals, like the same property management and
I don't.
Stuff?
I actually have diversified. So I've done a couple of deals with one or two partners, but most of the deals are people that I've just networked. So I would go back to your high performer out there audience. The key there to me is education and knowing the risk. So educate yourself. Invest some time in getting to know the Chris and the Randys of the world, the general partners that are offering the deals. Even if you've got cash and somebody offers you the shiny object with 20% IRR, pause and just think, does this really fit my investment thesis? Is this what I want to do? Maybe it does. Maybe you're developing your investment thesis, but give me a call. I'd love to help you kind of outline that. I encourage people I've coached along the way to actually put it on paper and hang it up on the wall so you can avoid that shiny object syndrome when it comes across the desk. Until you get more experience, and like you said, you want to find a general partner that's had multiple deals. But one guy I partnered with, I wanted to get, the quick story, I wanted to get into Phoenix. So I went to Phoenix. I live in Houston. I did a couple exploratory trips. I talked to brokers. I talked to property managers. And this was right around pre-COVID, so around 2021. And I remember, them saying, Randy, you don't live in the area. You don't own in the area. You're going to have to overpay for your first couple assets. And I went, really? That's ridiculous. So I wasn't willing to do that because other people's money, and that didn't fit my wheelhouse. So I found a guy that turns out to be a really good friend. I've worked with him now on, I guess this is still the first project, but he specialized in Tucson. He's gotten probably over the years 10, 15 different properties in Houston and Tucson. He's an expert in Tucson. There's no way I could ever accumulate the knowledge he has about Tucson anytime soon. So I partnered with him on the deal. And we bought a unit together out there, and I'm on the asset management calls and got my investors I'm taking care of. And, and it's had some challenges here in the last couple of years with interest rates. But it's an example of, to me, to your high-performing guy, the terminology I would use, that's risk mitigation strategies. By talking to somebody that's done it before in a geographic area, he's got all the property management contacts. He's got all the vendor contacts. Gosh, it'd take me years to develop that. You've said you specialize in Wisconsin. If you wanted to go to Indianapolis, you probably wouldn't feel as confident.
So what value did you bring? Obviously, you have a lot of experience, but what value did you bring to that partnership? If he's already there, he's got all the contacts, he knows the area, just kind of curious.
Well, no, that's fine. The specific one on that is I was capital raiser, asset management role would be the two roles that I would bring to that deal. Investor relations. So a piece of all three of those is what I brought to the deal. And quite honestly, it's the business, as my good mentor Mike Becker says, is very unfair. The business is very unfair. That came to me because of a relationship, not because of really something that I had to offer. I think I had some assets to offer, but there were probably 20 other guys out there with the same amount of assets or information, knowledge, and resources that I had. But it was one that I had nurtured for at least 2 or 3 years before we pulled the trigger.
Yeah.
And I tracked his investments, what he was doing, and his success rates. So,
nice.
The other thing there for your passive and the people who want to be active, Chris, this is take the long view. It's a long view. We're living in a bad time right now, and we're starting to come out of it, but it will return. That's the only thing we know is it will return.
Hopeful.
No, it will. It's just a matter of when. We hope sooner rather than later.
And then when you GP on deals, I think most do, but do you put your own money into the deals too? And is that something that, limited partners should ask their GPs and be concerned about if they're not?
Great point, Chris. And yes, that is one limited partners should ask the general partners if they're putting their own money in the deal. And as clarification, followed up with, are you putting cash in the deal or are you just rolling your acquisition fee forward? So for your listening audience, a lot of times the general partners at the time of buying the asset will take an acquisition fee, 0.5%, sometimes 1.5%, of the total raise, of the total buy, and distribute to themselves for their efforts up front and for their risk of getting loan and getting all the due diligence reports, et cetera, et cetera. So a lot of times you'll see people, general partners, that know that acquisition fee is coming, and so they'll answer the passive investor's question in the affirmative, yes, I am putting money in the deal. But they really don't have any cash in the deal. They've got their equity, which is, forgive me, for me, that's different than an answer to your question, yes, I put in cash. In every deal I sponsor, I'm a limited partner as well as a general partner. And that has made me feel more comfortable when I've had to have some difficult conversations with investors, to me to say, I regret that we're down right now, but I'm down more than you, or I'm down equal to you.
Yeah, good point.
That's a point. That's a conversation nobody wants to have, but if you do this long enough, it's going to happen.
Yeah, I mean, I've lent money a few times with my 401k, self-directed 401k, and that happened on one deal too. And that lender, it was a little bit different than an LP, but it was similar. But nonetheless, the guy who was kind of running the deal, more so like the GP, he basically said, like, look, I'm gonna make all of you whole before, like, I'll lose all my money before you guys lose a dime. And he did. And he gave us, not only that, he gave, like, there wasn't a preferred return, but he still gave us what he projected as the return, because that's how much he wanted to treat us. He wanted to follow through with his, not promise, but
And would you invest with that guy again?
Oh yeah, absolutely. Because that it's like, hey, sometimes the deal goes south. Sometimes it goes south, but he did all he could to make us whole. So
nobody likes to hear that, but you're right. Sometimes a deal can go south. And I had another, when I was a limited partner early on, in that same similar deal, the guy made all the limited partners whole at his own expense. That's real character. That's real quality. Yeah. Difficult to determine that going into a deal, but I respect the heck out of that guy, and I'll still invest with him today. All you got to do is call me, because he's quite high quality. So your
Definitely.
audience out there, the question is, how do you figure that out in advance? Very difficult, but you can ask the questions. Have you had any deals go south? And when I started doing this, if somebody said that, yes, that was a big red flag, run. I don't think it is anymore.
Yeah.
I think there are a lot of great operators out there that have had distressed assets these days and have either given them back to the lender or lost some money.
Yeah, for sure. And I mean, for this guy, I gave him a testimonial and stuff, and I don't think I mentioned that in the testimonial. I just, but nonetheless, I mean, there's stuff like that too, testimonials you can look at. And
sure.
I mean, there's only so much you can do till you get into the grind and you're actually doing a deal.
Well, ask the underwriting assumptions. Look at the pitch deck, ask the underwriting deck, ask for the qualifications of the general partnership team, ask for testimonies, like you said. Let me know 2 or 3 different investors that have been with you for a couple of years or in more than one deal, and I want to talk to them. I had one guy tell me, no, I'm not going to do that. And I go, thank you very much.
Right.
If they're not willing to do that. So there's things you can do. And then if you do your first deal, you begin to gain a whole lot more comfortable with it. So.
Yeah, for sure. All right. Well, so last question, we're going to kind of wrap things up here in just a minute, but I just wanted to ask the future of passive wealth. I wanted to ask what emerging trends you see will fundamentally change how passive investors evaluate multifamily deals.
It's a great question. I think the reason I talk to investors and brokers and stuff, and I mean, I still love multifamily because everybody needs a place to live, as we've talked about. You know that? You may not need a shopping mall, or you may not need an office space or the latest iPhone, but everybody needs a place to live as long as we're human beings. I still think that's a big characteristic, but change is coming. I hope change is coming is lower interest rates, but we'll see about that one. I believe I'm a buyer of real estate in all markets, up and down and sideways, but you buy very differently. So today I haven't bought any this year, but I would buy very differently than in prior years or even last year. And I think the other disruptor there is everybody, and I myself included, is trying to learn AI and how that impacts. It doesn't change the fundamentals. Everybody need a roof over their head. But it does provide a lot of advantages, and I think it's an equalizer to the small guys like you and I, because we can use AI to do a lot of due diligence that may have taken money and or a lot more time to get. I mean, you can put in a property and find out the crime statistics and the comps in the area, in seconds now.
Yeah.
It's a beautiful thing. So I view AI as a great equalizer. I could be wrong, but a couple things there, but.
I'm new to Texas, but I know Texas is a non-disclosure state in terms of sale prices and all that. So when you say that, that's just the question that came to my mind is, I mean, even if you had CoStar or something, you still don't get all the sale prices. So how do you work around that?
So I'm a CoStar user. You're more in the small single family space or the large, small multifamily space. I've heard, I looked at it when I first came to Texas, but it's been years. So the short answer, I don't know the answer for that, Chris. On the large multifamilies, you can find comps and rents because it's all kind of, CoStar puts all that information together, as you said. On the small side, there are some services out there, but I can't, off the top of my head, give those to you. I know there's some out there. So that's where I would encourage people, join your local real estate group, and somebody can guide you from there. REIs.
Yeah, for sure. For sure. Awesome, Randy. Well, hey, I appreciate your time. Where can people find and connect with you? What's the best way to get a hold of you?
Well, Chris, let me thank you again for the opportunity to be here. It's been fun. The easiest way to get me is I'm on social medias, the LinkedIns, the Facebooks. My webpage is invest-ark.com. That's .com. And we'll put that in the show notes. But there's a contact me page there. Love to chat with somebody, however I can help you. Love to do that.
All right, amazing. Well, thanks for all the value you've shared with us today, Randy. Love the conversation and appreciate your time.
All righty, Chris. See you.
Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.